Hi, I'm Corey. I'm a CPA and subject matter expert in financial accounting. And in this video, we're going to highlight the key details you need to know about a company's income taxes. We'll start off with a brief overview of what the income tax expense is. Next, we'll talk about how to measure and record both the income tax expense and the income tax payable, as well as discuss the impact this has on a company's profitability. Understanding how income taxes work is crucial for both accountants and the business as a whole. So let's dive right in. If you've ever earned income before, you likely realized very quickly that you usually have to pay taxes on these earnings. The government generates a significant amount of revenue from income taxes every year, which they use to provide benefits and cover programs for their citizens. The main sources of government revenue are usually individual and corporate income taxes. As a result, just like individuals, businesses are also required to pay taxes on their income. Taxation is a comprehensive process and requires knowledge of various rules and processes. It's extremely important that companies understand how they're being taxed, as it ultimately impacts both their profitability and cash flow. Before income taxes can be calculated, a company has to determine their net income before tax. This can be found on the income statement and is calculated based on the revenue a company has generated, less any operating expenses. The company will typically calculate their income tax expense by applying a predetermined tax rate to their taxable income. Organizations can work with tax professionals to determine their tax rate, which varies based on location and whether the company is structured as a corporation or small business. Just like businesses, individuals must also pay income taxes based on the employment income that they earn. Generally, this will be deducted at the source and remitted by the employer. However, if an individual is a contractor or small business owner, they'll have to remit their own taxes to the government. The government provides requirements for the amount of tax to be paid based on the earnings of the individual and the tax bracket that they fall under. Individuals will have to calculate their own income taxes payable amount by preparing a tax return or by soliciting the help of a tax professional to help prepare this for them. The tax expense is calculated as follows. Taxable income times tax rate equals the income tax expense. For example, if the company has a total taxable income of $100,000 and a tax rate of 18%, their income tax expense for that period would be $18,000. It's important that this is calculated correctly since it impacts the overall profitability of the organization. This $18,000 would be reported on the income statement and would be used to calculate the final net income after taxes for the company. The amount of revenue and expenses in a company's financial statements may differ from the amounts reported for income tax purposes, which are ultimately used to calculate the taxes payable for a company. The differences arise as a result of two factors. The first is permanent differences, which are differences due to financial reporting or taxation rules that result in differences that will remain permanently. An example of this is certain types of expenses that are not allowed for tax purposes, such as entertainment expenses. Temporary differences are differences that arise as a result of timing, when they're recorded as revenue or expenses in one period for accounting purposes, but in another period for tax purposes. An example of this is depreciation on long-lived assets. Companies have the flexibility to use a variety of methods to depreciate their assets for financial reporting purposes within their financial statements. However, the tax authorities require a very specific depreciation calculation for tax purposes to ensure that companies are not reducing their taxable income too much in order to avoid paying taxes. As a result, this creates a temporary difference between the financial statements and the taxable income reported in the tax return for tax purposes. These differences will be taken into account when calculating taxable income. A common ratio used to analyze the effect of income taxes on profitability is called the effective tax rate. This is calculated by taking the income tax expense and dividing it by the net income before taxes listed on the company's income statement. For example, if a company had $20,000 of income tax expenses and net income before taxes of $100,000, this would result in an effective tax rate of 20%. This rate is different than their marginal tax rate, which is the amount of additional tax paid for every additional dollar earned as income, and is the actual rate used to determine taxes payable. The effective tax rate will typically be lower than the marginal tax rate, since this reflects the amount of tax expected to be paid once certain allowable tax deductions and credits are taken into account. As a result, the effective tax rate is a good indicator that can be used by a company for planning and budgeting purposes in the future. Now that we have a better understanding of how income taxes work, let's discuss a common misconception. There's a difference between income tax expense and income tax payable. Income tax expense is the amount of tax that the company believes they will incur in each accounting period. This is the amount we discussed a few minutes ago that the company will calculate with the help of tax professionals and record in their income statement. Income tax payable, on the other hand, is the amount that the organization actually owes to the government based on taxable income reported on the company's tax return. This amount is not listed on the income statement, but instead shows up as a liability on the company's balance sheet. There can be differences in tax expense and tax payable resulting from some of the permanent and temporary differences that we discussed. Let's look at an example of ABC Company's income statement for the month of July. Here we can see the company had revenue of $90,000, less operating expenses of $36,000, bringing their income before taxes for the month to $54,000. Based on this, we can see the company recorded an income tax expense of $10,800 that month, which would have been calculated based on the company's understanding of their marginal tax rate and taxable income expectation. For example, if the tax rate for the company was 20%, this would be multiplied by the $54,000 income before tax to arrive at $10,800 income tax expense. We can calculate the company's effective tax rate here by taking the income tax expense and dividing it by the income before tax figure. This gives us 20%. This rate can be used to get an indication on how a company's tax is impacting their profitability and can be used by investors and creditors for comparative purposes across companies. Like we discussed earlier, the $10,800 tax expense may differ from the tax payable amount recorded on the company's balance sheet. Again, this would occur in the event a difference exists in the expense listed in the books and the actual amount the company expects to pay on their tax return. Any differences between these two numbers would be recorded in the financial statements as either a deferred tax asset or a deferred tax liability. Let's look at an example. Now, we said here that the company's income tax expense was $10,800. But let's say in this case, the firm believes their current income taxes payable to be only $10,000. This could be as a result of timing differences that will result in more tax being paid later. To account for this, they would record a deferred tax liability for the $800 difference, which would show up on the company's balance sheet. And with this journal entry, the company has now successfully recorded both its income tax expense and income tax payable amounts for the month of July. And that brings us to the end of this video. Remember, understanding how to calculate and report income tax is extremely important for organizations as it can have a significant impact to their financial statement results. Now, while it can be a complicated subject at times, many of the concepts discussed in this video can help simplify the process. While we just skimmed the surface here in this video, if you're interested in learning more, please feel free to check out our additional videos on many more related topics.